Hello, I am Brian Mitchell and I'm here behind the scenes at F&C Live with the fund manager of F&C Investment Trust, Paul Niven. How are you, Paul?
I'm good. Nice to see you, Brian.
Do you like the setup we've got going on here?
It's fantastic. The whole set looks great.
Good. Well, today you're doing a talk about social changes. Is there any indicators that you've noticed about social changes that are happening that are likely to stick? You know, for example, working from home, using Zoom for work after the pandemic. Is there anything that you've noticed as far as indicators go?
It's a really, really good question, a very difficult one to answer. I think one of the key points is that social change is ongoing. We're seeing social change all the time. A key question for us as investors is the duration and how long some of these changes actually stick for. And the pandemic provides some good examples, I think, of investors extrapolating short-term trends into longer-term conclusions. Numerous examples. I mean, working from home clearly persists to this day, but certain stocks, for example, were real beneficiaries of that whole stay-at-home environment, whether it was Peloton, Zoom, Grubhub. Mm-hmm. If you were working from home, eating from home, exercising from home, many examples. And investors got that wrong in terms of the permanence of that change. So it's a tremendous challenge and one we need to think about on a case-by-case basis.
Absolutely. From my experience anyway, Zoom is definitely the one that I now use and has become just the absolute norm. And who would have predicted that?
Well, I think certainly we could see a shift in terms of working patterns, and COVID arguably accelerated that, and certain elements did stick. But with Zoom, for example, Zoom gained by 765% in 2020, but it's fallen by 80% since. So tremendous gains from that stock, subsequently gave back a lot of them. Peloton, again, tremendous performer, gave up 97% of the gains.
Wow. So people have just adjusted. Maybe other companies have risen as a result of that to compete with those companies, and then it's kind of evened out?
So again, it comes back, I think, to the point about the permanence of some of these changes. Investors do tend to go to extremes of greed and fear. In that instance, extrapolating either a growth in the market, which didn't subsequently materialise, which I think was the case with Peloton, or with Zoom, where, to your example, there was a rise in the market in terms of video conferencing facilities becoming the norm, whether through Teams or Zoom or other competing applications. Mm-hmm. But the ability of certain companies to commercialise that and make money from that is, to some extent, not secondary, but equally as important as actually the change in the market itself. Mm.
So as a fund manager, then your job is to try and anticipate these things and allocate capital accordingly. How do you go about that then with F&C? How do you even try and predict what potential, because nobody could have predicted what was going to happen with the pandemic, what even the pandemic was going to happen, and the sort of social changes that's created. What sort of framework would you use to try and look forward as the fund manager?
Sure. Well, I think the first and important point is it is critically important to have a robust investment framework from which we can make investment decisions. A fundamental perspective is critical, and fundamentals relate to the broader macro environment. So what the environment is like in terms of growth, inflation and interest rates, because that's got a clear impact in terms of the outcome for asset classes, and often within respective asset classes. When one gets down to the more micro or stock specific level, certain themes, whether it's disruption in technology or demographic trends, they can drive certain themes within segments of the market. So we use specialists in terms of that macro perspective and specialists in terms of individual stock selection to help us identify the winners as well as the losers from what can be short as well as long-term trends. But it's important as well not just to have that fundamental pillar, but also to consider valuations, because there can be a great fundamental story. Some of the examples we talked about with the pandemic, but one needs to be very conscious of the price that you pay essentially for the stock. Because there are numerous examples of stocks becoming overinflated, over optimism being embedded. So having a valuation pillar is really, really important. And that kind of framework with fundamentals and valuations being considered enable us to distill essentially signal from noise, because there's an awful lot of noise around in markets.
So you need to have a real worldwide macro approach to everything. And it's easier to jump on the bandwagon after things have happened. Like everyone wants to buy a Zoom stock once Zoom is the thing that everybody's using. So you really have to try and be a step ahead of the game at all times then. Do you feel the pressure as a fund manager to always try and be Obviously, you've got to choose the right stocks and allocate capital accordingly. But how is that as from a pressure perspective from a fund manager? What is that a big burden to hold on your shoulders?
Well, look, I think it's a big responsibility. F&C is a large investment trust. We've got around £6 billion worth of assets. We've got many shareholders, and it's a really important investment in terms of the outcomes that we can provide to them for their financial future, and what the benefits that we can provide to them in terms of capital and income have a very real impact on many people. So it's a big responsibility, but it's a role which is tremendously interesting, given the breadth of consideration of opportunities which we have to think about. And a key point I would make as well is that diversification is really important. We certainly adopt a diversified approach in terms of portfolio construction, and that means that we're not going to get everything right, clearly, but we should have sufficient spread of risk in the portfolio to ensure that we do capture those winners from an early through to a late stage and hopefully avoid again some of those losers.
What makes you decide to make a change then? Obviously something huge like a pandemic, as we keep using that example, but is there anything else that kind of tips you over the edge to make a change in the portfolio?
So I think there's short and longer term considerations. Long-term considerations, very much strategic perspective with respect to outlook for assets. And F&C is invested largely in listed equities with around 10-12% of the portfolio in private equity. And the reason we're invested in those assets is that long-term view that equities are likely to provide a good return in real terms from both a capital and an income perspective. So that's a very strategic and long-term standpoint, and we don't change that view, particularly certainly for recent decades. In recent decades, we have been invested in listed equities and private equity. From a shorter term standpoint, it goes back to the points I was making earlier on with respect to our perspective on fundamentals and valuation. So essentially, we may change a view when our perspective changes in terms of the fundamental backdrop of the pandemic. Again, a great example of what was a short term but very meaningful impact in terms of the global economy, financial markets and so on. And we need to be very cognizant of trends as they emerge. And again, having the blend of top-down experts that we use in the process and bottom-up enables us to tap in at an early stage into some of those nascent trends. And so, for example, Nvidia has just overnight actually become the second largest company in the world, over $3 trillion in market capitalization, and that is the second biggest listed holding on our portfolio, one that we've held for some time now. It's made tremendous gains, added about $2 trillion in value in the past year alone, and they're at the forefront in terms of providing the technology through semiconductor chips to process the AI, or to progress the AI revolution. So tapping into themes like that early can lead to very substantial success.
Nvidia is a good topic, actually. I watched a video the other day that showed the kind of the growth of Nvidia versus Intel, and into they're kind of competing each other for so long, and then you just see Nvidia just absolutely rock off. Why is it, do you think, I know we're going straight off topic here, but why Nvidia? Why do you think they were the ones that kind of capitalized on the AI and the chip market?
So it's quite interesting, actually. So they have a dominant position in gaming, chips that provide the processors for gaming, and those are graphic processing units, GPUs. And they essentially, in contrast to CPUs, adopt parallel processing, which basically means they can run many processes simultaneously. And that is tremendously advantageous in terms of what AI needs to power applications. So they find themselves moving from gaming into AI, essentially, by virtue of the technology and their dominant position in a field which was entirely unrelated in the first instance, but applying that technology in a different way. And they control, it's been estimated, more than 90% of that specialist market in terms of chips that power the AI revolution, with those chips selling for up to $40,000.
Wow. I guess it's a snowball. Once it starts being utilised, more money get into it, more people buy the stock, and then the more innovation can be, or research and development go into it to boost it up even higher. That's interesting. So obviously with investing, especially in my world where I talk about personal finance, we often are told you can't say past performance is a reliable indicator of future results. But obviously that's the only thing that you can really use as far as making predictions in the future. How do you go about using past performance or things that have happened in the past to try and predict what is going to happen in the future?
So I think there is a saying, Mark Twain coined, did he not, that history doesn't repeat, but it does rhyme. So I think there are lessons from history that can be applied in terms of the future. And there's a number of aspects to that. From a high level perspective, we know that demographics are a huge driver of social change and returns in financial markets. Similarly, technological disruption has been ongoing and is now increasing at an exponential pace. That is going to be, and those factors are going to continue to be a continued driver of returns within equity markets. Equities themselves have provided fantastic long-term returns, certainly in recent decades. Because of the linkage to economic growth and providing a real return, I do expect that will continue. But another, I think, important lesson from history is that dominance in terms of individual companies tends not to last. And whether it's Nvidia or Microsoft or Amazon, these are phenomenal companies with a tremendous market position, dominant in each of their individual sectors. It's very, very difficult to tell when and if things might change. But again, the lesson of history is that companies tend not to dominate for a prolonged period of time. Again, an example, IBM used to be 7% of the US market, it's now 0.4%. So it's difficult to predict when and how things will change, but there will be future winners. As Nvidia has become one today, there will be another stock, which is perhaps small today, maybe doesn't even exist today, that will become a dominant player in global capital markets in the future.
So I guess that's why you essentially have to hedge your bets and diversify. Yes, you could put all your money into the Magnificent Seven or Google or Microsoft even, and potentially make a return. But what happens if in a year's time everything goes down and you haven't spread your money across a group of stocks or different assets? I do want to talk to you actually about the different assets that you consider when it comes to a portfolio. You're talking about equities. Is there anything else that you consider as from a fund manager's perspective, what different assets you do consider putting into the portfolio?
So for F&C, as I said, the focus is listed equity and private equity, and we think that fits perfectly in terms of the requirement to deliver long-term growth in capital and income. They should deliver real returns that are beneficial to our investors in the long run. We can also borrow to invest though as well. Yeah. So we're not putting money into fixed income markets. We're actually borrowing to use that capital to invest. And in recent years, actually, we fundamentally restructured our debt, taking advantage of very, very low interest rates, which have subsequently risen, such that we borrowed around £580 million worth of, or £580 million worth of debt at a blended rate of around 2.4% fixed. So that immunises us against rises in interest rates. We can use that capital to invest into equities. And if we make a return above that threshold, it will add returns to shareholders. So that's been, I think, another decision which has worked well for us.
Yeah, absolutely. So obviously we can't give financial advice to investors or potential investors, but from your perspective, what advice would you give to somebody who is either an investor or considering investing?
Excellent question. So I think what I would say is that one should take a long-term perspective when it comes to investing. The reason for that is the power of compound interest, or compounding more generally. Einstein called compounding the eighth wonder of the world, because essentially when you compound returns, you're making returns not only on the capital, but on those gains as well. And that can lead to quite extraordinary levels of return over extended periods of time. So take a long-term perspective. I am a fan of investment in equities and growth assets, because they do provide that real return characteristic, which can lead to strong returns, compound returns from a long-term standpoint. So point one would be take a long-term perspective and think about growth assets, obviously depending upon what age you are and when you're making those investment decisions. Secondly, I would say save early if you can, and save often. Now, we all have to make decisions in terms of our lifestyle and how we use our money, but if you can put away some savings early into growth assets, and you've got a long-term perspective, those savings should compound over long periods of time, which again provides a tremendous benefit. And then the third point would be one of the basics of investment, which is diversification. You should diversify. There are hot topics in markets, there are momentum trades, there are speculative areas of the market, and it's important, I think, to take a spread in terms of your exposure, ensure you're appropriately diversified so that if one of those more speculative areas of investment, whether that's in equities or elsewhere, does not perform, then you have other parts of the portfolio which will hopefully compensate.
So you're essentially taking the same approach as a fund manager's perspective, because you're managing, other people's money, or you've borrowed to invest that money. You'd say actually for the average person who's looking at investing, regardless of age, obviously time is the thing that allows compounding to actually help you. You take a very similar approach from a personal perspective, but also from a fund manager perspective.
Absolutely. I think those principles, certainly that I would apply in my personal life, I apply professionally as well. And we eat our own cooking. We have money in the products that we run. I have a substantial holding in the trust myself, and certainly my philosophy in terms of investment I have personally is applied professionally in terms of the trust.
Paul, thank you very much for your time today. I hope you enjoy the rest of the event. Let us know in the comments section your thoughts on the topics that we've covered today.